With Quest Nutrition making the shift from being simply a bar company to a successful platform or lifestyle brand, can the Simply Good Foods company do the same thing with the Atkins Nutritionals brand? I'll touch on some deeper thoughts surrounding that introduction a little bit later in this content, but on April 6th of 2022, the Simply Good Foods company did report its fiscal 2022 second quarter earnings for the period ending February 26th of 2022. As I usually do with these quarterly updates, I'll start by running through some of the high level financial data to update you on how the Simply Good Foods company is performed recently, but more importantly, use the earnings report, conference call, any like relevant publicly disclosed news to provide context for expanded strategic commentary on trends within the health and fitness snacking space. For new community members that maybe are not too familiar with the functional CPG brands that are in the Simply Good Foods company's portfolio, as I said in the introduction, they own Atkins Nutritionals and Quest Nutrition. So let's kind of dive into that high level financial information. In 2022 quarter two, the revenue for Simply Good Foods Company was $296.7 million. That was up 28.7% year over year and up 5.5% quarter over quarter. The North American side of the business was up 31.5%. The international was down 25.1%. This is really coming from the European business exit that created a large year over year comparative headwind. But if you think about just the core international net sales, they did have growth of 6.1% year over year. Total Simply Good Foods retail takeaway for the 13 weeks that ended February 27th of 2022, that increased 19.6% according to IRI's, kind of like all measured channels. This was slightly above the total nutritional snacking category growth in that same period, which was 19.6%. The gross margin for the business was 36.6%, which was down 250 basis points year over year and 480 basis points quarter over quarter. That is certainly not great, but could have been a lot worse. Leadership kind of stated that the supply chain cost inflation was partially offset by a previously discussed price increase that went into effect and favorable product form and customer mix. So let's kind of look at Atkins Nutritionals a little bit deeper. Their retail takeaway was up 6.4% year over year. This was slightly above the like weight management segment of the nutritional snacking category that saw growth of 0.4%. Bars were up 0.1%, but if we just look at like the mass channel, that was up 7% in this format, and shakes were up for Atkins 11.7% this quarter. All other formats saw 9.8% year over year growth. Amazon, which is the brand's second largest customer at this point, that was up 20% year over year. So shifting over to Quest Nutrition, their retail takeaway in the track channels increased 40.1% year over year. Quest Nutrition basically doubled up the active nutrition like subsegment of the nutritional snacking category that only saw growth of 20.5%. The retail takeaway for Quest bars increased 22% this quarter. And then the snackier portion of the Quest products continued to do well and increased 88% year over year with strong performance across all forms. Now, mass and convenience channel growth, which is extremely important for Quest Nutrition, this quarter, those were up nearly 45%. E-commerce continues to grow at a respectable rate at 14% compared to the previous year. This is especially true on Amazon, where the Quest bar continues to be the number one selling protein bar on that marketplace. Now, I want to transition into discussing what I was referring to in the introduction of this content. When Simply Good Foods Company bought Quest Nutrition in late 2019, Quest Nutrition was really just a bar company. It was just the Quest bar. Simply Good Foods Company does not get enough respect for transitioning that reality into now being a nine-figure CPG brand that has built a platform across several distinct product categories in the grocery sector. Now, the question is if they can do the same thing with Atkins Nutritionals. To be fair, Atkins is already like technically a massive like platform brand across bars and shakes. That said, the Atkins brand and those formats are tied closely to consumer mobility. As the restrictions or just kind of the consumer fear stemming from this endemic sustains, Atkins needs to perform a similar diversification that happened at Quest Nutrition. They need to get snackier and they need to do that fast. You've heard me talk about the indulged confections at Atkins, the success of that over the last maybe 4 to 6 quarters. And that success has driven the totality of those various forms to become about 25% of Atkins' total revenue. They also just recently launched protein chips under the Atkins Nutritionals brand, which kind of brings up a few points in my mind, at least. Is one, I bet that Quest Nutrition and Atkins Nutritionals protein chips share the same contract manufacturer. Yes, that's efficient. That's normally what happens in a portfolio company and makes a lot of sense to me. But what makes me a little bit uneasy is that the single biggest contributor to Quest's household penetration growth has been the growth in the protein chips. The Quest Nutrition protein chips could have been even a bigger impact to the brand if it wasn't for the lack of inventory due to outsized growth. If the Atkins Nutritionals like chips are taking available line time from Quest Nutrition, that's really a problem. If Atkins chips are taking available line time from a competitor and Quest is still getting enough to sustain demand, then that's totally fine. Though I really fear that it's the former and not the latter. Secondly, these types of cross pollination within the different forms are fine in my book. I think there's a few of the Atkins Indulge products that could easily become winners on the Quest Nutrition side in the future. This cross pollination can easily become, though, reckless and cause cannibalization between the brands. This can happen in two different ways. Firstly, they need to really make sure that they keep the brands distinct. Quest is about adding protein to your active lifestyle. Atkins is about helping you manage your weight. They need to continue to invest heavily into marketing that targets the right people, and they don't have to really worry too much about cannibalization. Secondly, you need to watch out for the market shifts that bring weight management and active nutrition closer together in the consumer's mind. If that's the case and that kind of happens, they will need to watch cannibalization and probably even look at divesting one of those names, to be completely honest, before it kind of gets super gnarly. And I assume it would probably be the Atkins brand. On an adjacent product note, the Simply Good Foods leadership was asked on the conference call about further innovation outside of the nutritional snacking set. And they said that we like snacking in our aisle. We feel the deployment of the resources against that is our biggest and highest leverage opportunity. They just announced that last month they entered into an agreement to license the Quest frozen pizza business to the company that's held the license for the Atkins frozen meals for several years. They ran that business for a few years and they concluded that it's not a core strength in the supply chain, customer relationships, or category innovation. I do, though, still think a deeper innovation strategy around frozen would be a good idea for Quest, especially when we're talking about the breakfast category. I want to shift this a little bit into mergers and acquisitions commentary. 2 to 3 years ago, the company did have leverage around 4 times when they purchased Quest. So the number one job was for them to deleverage their balance sheet. Now they have done that. It's around 1.6 times, which is a very comfortable place to be at to do mergers and acquisitions. The issue, though, has been that valuations of the targets are a little bit crazy. The IPO markets are now starting to dry up and entrepreneurs are starting to get realistic again. The Simply Good Foods company is really in this like nice to have and not a need to have situation. And they're confident that they can kind of wait a little bit longer. At least in my opinion, I think that the Simply Good Foods company leadership kicks the mergers and acquisitions can down the street and doesn't make a deal until the economy gets a little bit worse. They will utilize capital to continue paying down debt, deleverage their balance sheet a little bit further, and continue to do share buybacks. So I just want to end on some quick final thoughts. I did just note that until the economy gets worse, and it's not necessarily a guarantee, but the yield curve did recently invert, and that gives you a good chance that we will have a recession within the next 1 to 2 years. So, how does the Simply Good Foods company do in a recession? Because the company really didn't exist at the time, but the brands did. And I think, in my opinion, humans will continue to invest in themselves. They'll make use of low ticket items to make their lives a little bit better. That's a good setup for the company, regardless of what happens next with the economy. If you enjoyed this YouTube video, hit that like button to support me. Also, help me get to my short term goal of 2,000 subscribers by hitting that subscribe button. I'd love to see you join me on this journey, but we need to fix the fact that slightly more than 80% of you that are watching this YouTube video right now are not subscribed to my channel, and that makes me extremely sad. Thank you again, though, for tuning in, and I'll see you on the next one.